Good afternoon. It's nice to see all of your smiling faces today. Welcome to Berry Hall. Welcome to our Financial Markets Day, as we call it, a bit of a celebration here with the Challey Institute for Global Innovation and Growth, along with the CFA Society of Minnesota. We're happy that we've got some of our CFA partners here today. We have some students here today and some longtime supporters of our events and our college here today. So excited to see all of you. Thank you for coming. We are going to have a bit of a fireside chat to start, and then we will open it up for questions. So if you have questions along the way, keep them in mind, and we will open it up so you can have the opportunity to ask our guests some questions. We'll take a little bit of a break just before 4 o'clock, have a refreshment break, and set up some more chairs because I have more people to talk with you. So we'll do a panel then with our other speakers after that 4 o'clock hour, some more questions, and another time for you to ask as well. So there should be no shortage of questions coming from the audience today. Did you understand your assignment? Great. Okay, please join me in welcoming our guest of honor, Steve Kaplan. Yes, applause. Yes. Dr. Kaplan is the Neubauer Family Distinguished Service Professor of Entrepreneurship and Finance and the Faculty Director of the Polsky Center for Entrepreneurship and Innovation at the Booth School of Business at the University of Chicago. He conducts research on private equity, venture capital, entrepreneurial finance, corporate governance, and corporate finance. He's published papers in too many academic journals for me to count, and he's a research associate at the National Bureau of Economic Research. He is the co-creator of the Kaplan, I didn't ask you how to pronounce this one. Kaplan-Shore. I practiced all the words but that one. Kaplan-Shore PME, or Public Market Equivalent Private Equity Benchmarking Approach. This part I love. Fortune magazine referred to him as probably the foremost private equity scholar in the galaxy. Kaplan teaches advanced MBA and executive courses in entrepreneurial finance, private equity, corporate finance, corporate governance, and wealth management. He's been named one of the top 12 business school teachers in the country, and he tells me that his total now is over 10,000 students, which is quite an accomplishment. He co-founded the Center for Entrepreneurship and the Program for Entrepreneurship at Booth. His students helped to start Booth's business plan competition, which is called the New Venture Challenge, which has included over 800 companies. They've now raised over $2 billion, and created over $10 billion in value, including companies such as Grubhub, Braintree, Venmo, Tavala, and Simple Mills. He serves on the board of Morningstar and several fund and company advisory groups. He's a member of the faculty since 1988. He joined after receiving his A.B. summa cum laude in applied math and economics from Harvard and a PhD in business economics from Harvard. I can't even keep that list going. I'm so excited to have you. Please join me in welcoming Dr. Steve Kaplan. I love it.
Thank you.
So I just did this really long introduction about you so that everyone knows all the things. But really the reason and the focus, the topic that we're discussing today is more focused on private equity, that idea of private equity. It intrigues many of our students, many of our charter holders, because it brings together that idea of finance and entrepreneurship. So there are some proponents, but there are some skeptics of private equity. Can you give us a breakdown of maybe both of those sides and maybe where you lie on the proponent or opponent?
Okay, and we have 2 hours?
Sure.
No, so first of all, I'm delighted to be here. I've driven through, and that's a long story. It was September 2001, and I had to be the best man in my brother's wedding in Seattle. And I drove 36 hours with my wife and 2 little kids. And we drove through Fargo on the way and on the way back. So I'm so much happier to be here today than I was then. So thank you for having me and listening to me. So private equity means a lot of things to a lot of people. So let me start off by saying there are buyouts and there's venture capital. And there's growth equity in between, which are all forms of private equity, because private equity is just private investments in the equity of companies. And I think venture capital is not so controversial. Everybody loves venture capital, or they used to. I mean, maybe now it's a little more controversial, but it's largely venture. You're doing startups, you're creating innovation, and that's less controversial, I would say, and has done like amazing things. If you look at the most valuable U.S. companies and the U.S. companies that have created lots of jobs and lots of technology, they're venture funded. On the other side, you've got buyouts, and buyouts are the more controversial ones. And in a buyout, that's where a private equity firm like a KKR or an Apollo will buy a company. Sometimes they're public, and so they'll take the company private. Sometimes they're a family business, and they'll buy it from the family to, entirely or a partial extent, and then own it. Sometimes it's a division of a larger company. So you have all kinds of buyout types investments. And the buyouts are controversial because on the one hand, there's a view, they put a lot of leverage on the company. And sometimes when you put leverage on the company, they go bankrupt. And so there have been some famous ones. Toys R Us is probably the most famous one. And they're controversial too because there's also, when you do have these bankruptcies, you lose jobs, and that usually gets or often gets attention from the press. So that's the controversial part. Do buyouts just gut the companies? You buy a company, you sell things, you gut it, and you make money by really sort of destroying it. The other view, which is the positive one, is you're going into these companies and you're making them better. And those are the two views. And if you read the popular press, you will, I think, overwhelmingly may be a strong word, but I don't think so. You'll overwhelmingly get the negative because they're usually, stories they can write. They find the person who was hurt, and you get a lot of the negative stories. And what I've done over the course of my career is tried to do research on the entirety of the industry. And that means looking at, as many deals as you can to sort of see, okay, here there are good ones, there are bad ones. How does that all work out? And what you find is that on average, the private equity investors make the companies more efficient. And so this story that they're gutting the companies is just not correct on average. There are obviously deals that don't do well, but there are deals that do well. And on average, the deals do well. And they kind of have to, because if they didn't, if you do a deal and you gut a company, the way you make money is you sell the company. And if you've done something bad to the company, you can't sell it. Nobody's going to buy it. So it's sort of like, to my mind, ridiculous when people have this really negative view, because you just can't make money that way. You have to do something good to the company in order to make money. So if you look at the economics of these deals, whether they make the companies more productive, on average they do. If you look at employment, which is the controversial one, you find sort of a difference. If you find that the private to private deals where you're buying an existing business that's not public, you tend to actually see employment go up, and go up by more than similar companies in the same industry. The place where you do see a decline in employment somewhat relative to other companies in the same industry is the public to privates. And those are probably the ones where the company has not been managed very effectively. You take it private, more or less there's some fat or not well managed parts, you fix those, and then you go off and grow them. But that's the basic evidence. It's, I would say, overall positive, but there are positives and negatives. You add it all up, I would say positive.
So it's not the buy it and tear it up and sell it off for parts idea that some would prefer us to hear?
I mean, the buy it and tear it up, no. The tearing up in parts was really something that was more in the 80s. And the other thing in the 80s that's interesting, this is where they get that reputation, the 80s deals were done for let's say a $1 billion transaction, you could get $900 million of debt. So it was 90% debt, 10% equity. And that turned out to be crazy. A lot of those deals did default in the early 90s. Since then, or really since the beginning of the century, the deals are done 50% debt, 50% equity. So they're leveraged. They have 50% debt, but there's 50% equity. So your house is more highly leveraged than most of the leveraged buyouts because your house is 80% leveraged, and these deals are 50% leveraged. So leverage matters, and if you don't make your payments, you get into financial trouble. But it's not like these are these massively leveraged companies that they were back in the 80s.
So we've seen a transition in the types of structure of deals in private equity, and over time, the perhaps maybe more conservative estimate of that leverage. But speaking in this sort of shorter term, private equity has a cyclical component to it, as most macroeconomic things do. So what is your expectation, or what would you predict in the private equity markets for the next sort of 2 to 6 years, perhaps?
Okay, so I'll talk about 2 to 6 years soon, but let me go back to the other question, sort of tell you what has happened a bit since the sort of 80s and 90s. And this goes back to, again, whether they're forces for good or forces for bad. All of most of the private equity firms now, when they buy a company with the idea that they're going to make it better. And this was, again, less true in the 80s, that they had a plan. Now, when they buy something, they have a plan. They don't buy a company unless they have some plan to improve it. And they've built up all these the private equity firms, employees or advisors who are not just financial people, but are operating people. And that was much less true 20 or 30 years ago. Actually, one of the first people to do that was Mitt Romney, actually. He was an innovator and was a very successful private equity investor. And so most of these firms now, when they buy a company, they've got industry experts. They look at the company and they say, look, it's doing this, we can do this better. And there'll be some cost cutting, but it's much more like growing the business, bringing in technology, improving it. And there's actually Aldevron. Have you heard of Aldevron here? I'm told it's local. Aldevron was bought by a private equity company. And that private equity firm, I think it was EQT, transformed its business to the point where it could be a supplier for the mRNA vaccines. And so there's another actually supplier to mRNA vaccines that was also a private equity deal. And you might not have your vaccines if you didn't have those two private equity deals to create big suppliers for the vaccine. So that's one example. Sun Country Airlines, did any of you know Sun Country Airlines? That's a Minneapolis. That was bought by Apollo right before the pandemic. And you would have thought buying an airline right before the pandemic would be a disaster. They actually invested in that airline. They put in technology. They changed the strategy somewhat. And it's been a successful airline through the pandemic, which again, if they were gutting it, that would not have been what you would have seen. So it really has changed over time what they do. And it's also grown tremendously, which is part of the reason why I'm probably here, and why you should be interested. Private equity now, on the buyout side, is probably 10 or 15% of the economy. And then if you have venture, you have real estate, you have energy, private equity, you have a bunch of different verticals, infrastructure, you might get to 15, 20% of the economy. So there's a lot of things that are touched by private equity, and the companies are trying to get better. So they're actually interesting places to work, either if you want to work for one of those companies. And then there's, on the finance side, there's a lot of work, either being a private equity investor or being a service provider to the private equity firms. And then on the consulting side, there's a lot of work. And one of my panelists later actually has both of those things, that he's private equity owned and he consults to private equity owned firms. So that's where we started with these highly leveraged things, and then we've come to the point where they're somewhat leveraged and they're really put a lot of resources into making the businesses better. And now the question is, where are we going, was your question, the next 2 to 6 years. And that's going to be very interesting. I think what I said earlier is the returns historically on private equity investments have been extremely good and better than the S&P 500 or the public markets. That's why some private equity investors have gotten very wealthy. It's another reason it's controversial. And that has been true, really, I would say it's like an unbelievable track record. If you look at sort of every year, if you bought all the funds that were raised in a particular year from like 1992 to 2019, you would have, and that's, how many years is that? That's 27 years, 28 years. There was like 1 year where it underperformed the S&P 500, and it barely underperformed. So you have this unbelievable track record where if you just bought the average fund, you beat the public markets, and that's part of the reason it's grown so much. 2020 and 21, they did deals in the pandemic people got carried away. They did deals at crazy valuations. The venture capitalists did this too, and they were crazy. They were maybe a little worse, but everybody got carried away, which is sort of strange since the rest of us were like not getting carried away. And it was a tough time, but on the finance side, it was crazy. People did a lot of deals at high valuations, and I think what's going to happen is the funds raised in 20 and 21 are going to underperform the public markets. That's going to become clearer. It sort of is a little clear now, and that is going to get negative attention from the press, and deservedly. And so you're going to see, I think there'll be some, I don't think it'll go down, but it'll be sort of some volatility with private equity. Now, that may make it a good time to invest, because the other times when the returns were just okay was around the great financial crisis. So funds raised 06, 07, 08 did just okay. And then the funds raised 09, 10, 11 did very well. So you have this funny pattern of boom and bust, along with things going up over time and the returns being good. You have some cyclicality. So we're going to be seeing the results of a little excess. So the returns are not going to be great. And historically, that's been a good time to invest. But we'll see. The thing that's tricky again is you have all these firms that are competing with each other that really are good at adding value. And so when they compete for a deal, they end up bidding the price up. So it's good to be a seller because you get the benefit of the competition. And so, time will tell. Right. As it's always the case. It's really easy I shouldn't say it's easy. It's easier to look backward. There I can be pretty sure I'm right going forward. I have a 50% chance of being right, just like anybody else.
Yeah. Well, I mean, much to the chagrin of all of the charter holders in the room, I can't really ask you for advice, but that sounds to all of us like perhaps it maybe is not a bad time to be buying soon, which would be nice. This is not a non sequitur. I planned the question. I'm going to change topics to one other one, change topics. I'm going to expand our topics to one of the other ones that you're working on, which is actually connected. So you had mentioned that the private equity firms, when we first started, it was a lot of finance, but now they're adding some operations in there. The guiding those firms are CEOs, and the CEOs that come in and take over or are bought by private equity. You've done a little bit of research on that. So I have some young professionals in the audience. We have some students in the audience, and your research, I think, could be interesting to them. You've been researching on the traits of CEOs that make them more successful. So what have you found?
So this is also, how are we doing on time? Okay, I've got this there's a lot here, because I could literally answer this question, take an hour. So first of all, what's very interesting is when you talk to the private equity investors, they'll say they spend a lot of time understanding the business, the market, the competition, and whether the firms that they're investing in have competitive advantage. They also try to figure out is the management team that they're investing in, and in particular the CEO, are they good? And historically, they spent more time on the business and less time on the team. And when I asked them, how successful were you in picking the team, they'd say it's like 50-50, it's really hard. And that's terrible, right? If you can get that up from 50-50 to 75-25, you're gonna, your companies are gonna do better and you're gonna make more money. So over time, there have been firms that have evolved that assess management teams, and they're specialists in assessing people. And now there are external firms that are consultants. There are also, the private equity firms, the bigger ones, are now bringing some of this in-house. And I've been able over time, been able to have a partnership and get data from one of the early assessment firms that's done very well. It's a firm called GH Smart. So I have all this data on CEOs, because what they do is when a private equity firm is thinking of making an investment, they'll hire GH Smart to assess the CEO. And GH Smart now does this for public companies as well as private equity, but they started in private equity. And they will take the CEO candidate and interview him or her for 4 hours. Any of you gone through a 4-hour interview? Think that'd be fun? Any of you want to be a CEO? Any of the students out there? Nobody's raising their hand. You guys, you don't want to be a CEO? Do you want to be private equity investors?
This is very North Dakota.
I'm wondering what they're doing here.
This is very North
Dakota.
Say, huh? No one's going to raise their hand. This is very North Dakota. No one really wants to.
You're going to have to raise your hand in a second. You're going to have to raise your hand, or I'm going to walk out. You'll see why, because I'm going to ask you a question. So, in any event, I get these 4-hour interviews where it's all about what the person has done in their career, and when they're done, the person from GH Smart assesses the candidate on like 30 different things. And these 30 different things are, have to do with, how do you communicate? How do you deal with employees? How do you, manage? Are you creative? Are you strategic? 30 different things, leadership. And you can take those 30 different variables and they really compress into 4 things. When you look at them statistically, those 30 variables, you can explain a lot of the variation with 4 variables. And the 4 variables are these. So one looks like general talent. So somebody who scores well on one of these 30 things tends to score well on a lot of them. So I'm going to add them all up and call that just talent. The second one is very interesting, that there are some people who load up very highly on execution, things that look like execution, like moving fast, being proactive, being efficient. And then there are other people who are more loading up on interpersonal skills, like being a good listener, treating people with respect, being a team player. And people tend to, like, those variables explain a lot of variation when you add them up. And so you add them up, and some people are the interpersonal people, some people are the execution people among the CEO candidates. Then the third one looks a bit like charisma. Some people are persuasive, they're extroverted, they're enthusiastic, and that contrasts with people who are more to, like, managerial or bean counters. So call the third variable charisma. And then the fourth variable looks like something like creative strategic. So it's creativity, strategic, intelligence, etc. So those are the four variables. So the question I want to ask is, are CEOs, and these are the CEO candidates, I'll tell you about who gets picked, but the CEO candidates, are CEOs more talented or less talented than other C-level people? So they're CFOs, COOs, division heads. Are CEOs more talented or less talented? So how many of you think they're more talented? And how many think they're less talented? Now you have to vote.
You have to raise,
so
yes.
how many think they're more talented? And how many think they're less talented? It's a cynical vote. They're more talented. CEOs are more talented. So look, your former governor was a CEO, right? So there you go. Okay, number 2, execution versus interpersonal. Are CEOs more execution or more interpersonal? How many think execution? And how many think interpersonal? Oh, that's interesting. So that was kind of 50-50,
yeah,
60-40.
I would say 50-50, yeah.
Right, that way you have no idea. Good. Turns out it's execution. It's execution for the candidates rather than interpersonal. Charismatic versus not. How many think more charismatic? How many think not? Okay, you got one right. That's correct. They're definitely more charismatic. And how about strategic versus not? How many think they're more strategic? And how many think not? Okay, you got that right. So they're more talented, they're more strategic, they're more charismatic, and they're more execution oriented. So that's who becomes a candidate. 2 other things to tell you: who gets hired and then who succeeds. Okay, so of the ones who get hired, the one that's interesting, that moves around, is the execution interpersonal. The people who get hired tend to be a little better on the interpersonal. So that execution, the candidates are strong on execution. The people who get hired are still better on execution than the average executive, but less so than the candidate. So it seems like the boards will tend to hire the person that they like among this group. They also tend to hire the more talented ones and a little bit more on the charismatic side. So that all goes, and at the end of the day, CEOs are more talented, they're more execution oriented, they're more charismatic, and they're more creative strategic. So now let's look at who's successful. And again, the variable, the factor that actually matters the most in this is that execution interpersonal. So what do you think matters for performance? Once you're a CEO, is it execution or interpersonal? So now, how many of you vote for execution? And how many of you vote for interpersonal? Okay, you still have no idea. The answer is execution. So if I have to, going back to advice, if you want to be a CEO or a leader, the thing I take away from this, and I've done some other work that's very consistent with this with other groups, is execution is hugely important, and that means getting things done. So you can be, really likable and, the nicest person. If you don't get things done, you are not gonna get the job, and then you're also not gonna be successful. So my advice is don't be a jerk. So I'm not saying be a jerk, but the advice is, in your jobs, if you can, on the margin, like move a little more quickly, make sure you get something done, that pays off quite well.
That was going to be my next question, which was you've had 10,000 students. So what advice would you give to students, either from your career as career advice or from the people that you work with or any of the things that you've seen, many of the ones that you've mentored? What's your advice?
I think that there are several, and I've had
Great.
some good students. I had Satya Nadella, who was a student, many years ago, and he's now runs Microsoft. I had Brian Nichols, who's the CEO of Starbucks. I've had Tom Ricketts, who runs the Cubs, and those are some of my more memorable students. Caitlin Smith, who built Simple Mills, was the company, one of my new venture challenge companies, and she started it in 2013. She started it with gluten-free, low-sugar baked goods. And last year, she had $240 million in revenue. She was the largest natural baker in the country, and she sold her business for $800 million. And she's awesome. So I've had some wonderful students. So what do I tell them? I tell them, first of all, make sure you get things done. So that's the execution thing. I think there are two other things that I tell people. One is be ambitious, because you'll find, and this is, I think, particularly for younger people now, this is good advice. It's good advice for anybody, but be ambitious, because there are a lot of people, and it drives me crazy, who are very talented and they aim here. And it's if you aim there, that's the best you can do. And I've seen it. I have great students. You aim here, some of them end up there, right? The Satya Nadellas of this world, he got there. But even if you don't get there, you get there, that's pretty good. That's great. But if the worst thing is you have talent and you don't apply it. So I encourage them to do that. And then the third thing, which maybe is well, you'll tell me what you think of this. And it has to do with execution. But it's a lot of times people are afraid to bother me or afraid to ask me for something. And, I'll find out later they didn't ask me, did I know somebody or could I introduce them to somebody? I'm saying, of course I could have done that. Why didn't you ask me? And they say, I didn't want to bother you. And so I tell them, don't ask, don't get. Because if you don't ask, you're not getting it. If you ask, you'll be surprised. Some people, a lot of times I'll just say no, but sometimes I'll say yes, and sometimes somebody, very senior will actually say yes, and you'll get something out of it. So as long as you don't make a nuisance of yourself, don't ask, don't get. So those are the three.
And when you have students who ask you for things, I think sometimes our students or our colleagues or whatnot are afraid to ask because you'll remember, they'll remember that you said no to it, but do you remember that you said no to them? No. I hardly ever remember when I said no when I couldn't do something. And I'm ask me again another time. I couldn't do it at this point, but.
Sometimes I don't remember. Actually, it's even better than that. So sometimes, sometimes we'll say yes, right? Yeah. Sometimes we'll say no, but who cares? Sometimes it's very impressive that you asked me. And even though I couldn't do it, I'll say, that took some guts, that took some, some ambition. And so I remember, gee, that person, that was a good thing, even though I'm not going to help you. And then it may be a month or a year later, you'll ask again and I will help you.
Yeah.
So.
Yeah. I agree. No one says yes unless you raise your hand, so you got to raise your hand to ask.
Exactly.
So because I am a stickler on time, I'm now, of course, over my time, which is now time for Q&A. So I want to make sure that you get enough time to ask questions as the audience. So we do have a microphone right there in the middle. So make sure that if you're going to ask a question, you come up to the microphone, and I will make sure that we paraphrase it for our online audience in case we need to. Allison is going to come and turn on that microphone so that we'll all be able to hear it. So remember at the beginning where I told you that you were going to have 2 opportunities for asking questions. Now is your first one. Maybe that's my microphone is probably the problem. Fantastic. Please go for it.
Somebody has to start.
Yes, somebody has to start.
3-part question on private equity. Number one, when a company buys another company, do they typically buy full control, or are they just buying enough of a percentage to control the company? So that's the first question. Second question is crowdfunding. What impact does crowdfunding have on financing companies today? And the third and last question, in terms of today's world, where would you put the needle for leverage? There's a certain amount of leverage where it's just not possible to be successful. So those are my 3 questions.
Okay, those are all good questions. So control it varies with the private equity investment. So on the venture capital side, when a venture capitalist invests in a company, they're getting 20% of the company usually in a financing round. Over time, the venture capitalists own more, but the first venture capital financing is 20%, so they don't have control. And so they put in contracts, or in the contract in which they invest, they put in ways that they're protected against management because they don't have control. And in fact, the one time when venture capitalists were sloppy in that was FTX. When they invested in Sam Bankman-Fried and FTX, they didn't put that structure in, and you know what happened. Didn't end happily. So that's on the venture side. On the buyout side, they're usually buying control. And so, but it varies. Some deals, they're buying 100% of the company. And like a public to private deal, they're usually buying all of it because they're paying off the public shareholders. The thing that's actually quite interesting is when they buy private companies, maybe it's a family business, or that would be, that hasn't gotten funded before. And I see this, my students sometimes will go out and buy small companies. A lot of times the family or the existing team will roll into the deal. And I'd say 20% of their stake, so they'll sell 75 or 80 to the private equity firm, and then they'll roll 20 or 25. And that's actually a nice thing for both sides because it tells the private equity firm that the seller believes enough in the company that they're going to stick around. And for the seller, it says, well, if things go well, and if the private equity firm actually adds some value, I can make as much money on the second part as I made. If this was 75, this is 25, but I make 3 times my money on the 25, it's 75 and 75. So that's kind of, it's a continuum. Venture is over here, buyout is over here, and growth equity is somewhere in between. So that was one. Crowdfunding, it's crowdfunding. The tricky thing with crowdfunding is if you're raising crowdfunding, that's okay. But if you're the crowdfunder, beware, right? Because that's where you have, I should say, it's hard enough for venture capitalists. Venture capitalists, if you look at their returns, there are some years where they don't beat the S&P 500, which the buyout firms have done that continually. The venture firms, some years they do a lot better, some years they do worse, but it's very hard to be a venture investor, and they're putting all the due diligence in, they're working really hard, they invest in one company for every 100 they look at, and they still, half of their company investments they lose money on, and they make their big money on a few winners. So with crowdfunding, if you're the crowdfunder, it's like you're almost certainly going to get a bad return. If you're the person who's raising the crowdfunding, maybe it's dumb money, but you have to make sure that it's not money that interferes with you. So I'm not a big crowdfunding fan, and I don't think it's a very big thing, for big dollars these days for the reasons I just said. And then leverage, what's the right amount of leverage? The right amount of leverage is the amount of leverage you can service. So if you are, if you have a really stable business and it's not going to be affected by tariffs or whatever, then you can take on a fair amount of leverage. If it's a business that has a lot of volatility baked into it, then I don't want to take on leverage. And the rates matter too. If rates are low, you can take on more leverage, and if rates are high, less. And that's why when the rates went up, you see less leverage. So that's a question that moves around, or the answer to that moves around.
Thank you very much.
Mm-hmm.
Hello.
Hi, I'd like to ask this question, if I may. I work in the investment business, and every Tom, Dick, and Harry today is typing private equity. Every firm is promoting it. You need to have X amount in there, which leads me to believe it might be too late. But what would you recommend for the retail investor that's getting approached on private equity? How might they do their research or make decisions relative to that investment?
So the retail investment is very that I'd be very careful about. The first thing to be really careful about is the fees on private equity in general are high, right? They're 2% management fee, which is high, and then it's 20% of the profits. And so that's a big headwind for an investor in these funds, that the returns on the investments have to be high enough to pay the fees. On the retail side, if you add fees on top of that 2 and 20, then it gets even harder. So the thing I'd look at first if I'm a retail investor of any size is what's the extra fee on top of that 2 and 20, and I'd be very careful about that. Sometimes you see somebody is going to take 1 or 2% plus maybe a share of the profits on top of that. So that's going to make it hard to outperform just putting your money in the S&P 500 or any stock index. So I think that's one. The other thing that's tricky with the retail investor is which funds you can actually get into. And this is where I have a preference. Again, I probably have a 50% chance of being right, but the mega funds, which is the Blackstones of this world, if you look at Blackstone's performance on private equity, net of fees, it's been S&P 500 for the last 10 years. So KKR has beaten the S&P 500, Blackstone has, and I'm not sure Apollo has. So, and then if you put fees on top of that, you have to worry. If I were doing it, I'm much more of a middle market person, where I like the middle market funds, because the disadvantage the mega funds have is these are the ones doing the really big deals. When you do a really big deal, you can't sell it to anybody, right? Because you're the biggest person. So you're really, you're going to exit with an IPO, which takes a long time, or maybe you're lucky there's another big company you can sell it to, but then you have to worry about antitrust. And so the mega funds have a little bit, I think, structural disadvantage now that they've gotten so big. And so the performance has been just okay. The fees are, I worry about the extra fees. And so if I were going to do this, I would look at the middle market. And, that's the challenge on the retail side.
We talked about this in our office this morning, but in this current economic climate and the tariff situation and everything, and the increased cost of the supply chain stuff that comes from overseas and stuff, isn't there a short-term risk to your stable of investments, some of them at least, that have look pretty pretty solid, and now all of a sudden kind of scary with the short-term changes. And then, but that, on the other side, isn't there a real short-term opportunity with those that are suffering too and maybe available?
So if you know what's going to happen in the next year, tell me, because again, nobody knows for sure. But I think if the tariffs they're clearly, putting in volatility, and let's say they do put us in a recession or are recessionary, which is possible, then that's going to put pressure on all companies. I mean, that's why the stock market has come down the last month. People are worried about that. If you have leverage, that's, any downturn or recession, bites more because you got to make the interest payments. So there will be, I think, if that happens, and particularly on for the industrials, there will be some, pain or some distress. Now, the question is what happens there and what opportunities there are. A lot of money in the last 10 years has gone to private credit funds, which are debt funds that invest in the debt in private equity deals. They'll have a lot to do, actually, to put money in under favorable terms. And that's where I think there'll be an opportunity. But I think the returns on the existing private equity investments will be hurt. And that's where those 20 and 21 deals that I mentioned earlier, which were done at high valuations, those are going to be the ones that will get even worse. So I think the short answer to your question is yes. And the long answer is what I just gave.
Well, this will be Scott will have one more question, and then we'll have a break after that. So you get our last question.
Okay, so this question isn't for me as much as it is for the students in the room and for those who are younger in their career. I'm closer to the end of my career. With respect to your CEO research and the execution versus the interpersonal skills and all that sort of stuff, is there a career path that makes more sense for them to get on? Sales, heading into CEO world, execution in the way of operations of a business, becoming the CEO. What's the best way to get there?
I mean, there's also the strategic, because they were good on strategy too. I think it's always, what I tell students are a few things. Figure out what you like and what you're good at. That's the first order thing. If you like operations and getting into things, go start there and make sure you work on having a little charisma, be a little enthusiastic, think on your strategic side. If you're the creative strategic person, maybe do consulting, work on that, and at some point maybe go on the operating side as well. So it's really, I would start, if you're good at sales, go sell. And just realize that you want to get a chance to run something, because to become a CEO, you probably have to run something, not just sales. So it really is, I would say, start at a place where you think you're going to like it, where you're working with really good people, and then work hard in whatever job you take, execute on that job. And then to become a CEO, I think you'll over time, if you do a good job in one place, then you'll get opportunities to broaden and to have more experiences.